And it's time for our Muni moment, a focus on the municipal bond sector and the latest data out there saying that it's still being affected by that flight of cash into money markets. James Kemp joining us right now, Managing Director of Strategic Income over at Eagle Asset Management. James, let's start off here with that, I guess, flow of cash. We won't call it a flight here, but we know that a lot of people did seek out the safety of shorter-term treasuries, shorter-term money markets here. How has the Muni market, if at all, been affected by that reshuffling of cash positions?
Romaine, good to be with you. I think every asset class has been affected. I mean, the amount of money going into the money complex, the short-term investments, is really staggering. So what we see is 9 of the last 11 weeks, we've had outflows from the municipal market, which has allowed them to get a little cheaper on a relative basis. But as we know, everything's kind of built around the Treasury curve. And as we speak today, with a reasonably sanguine inflation report, we're getting rallies in Treasury. So we're getting better yield ratios out of the long-term municipal bonds. But we have a little bit of a rally in Treasury, so maybe a little bit of a leg in kind of approach at this point.
So you think right now that munis are more attractive in the longer maturities than the shorter maturities. Can you explain why that is and talk about how whether supply at longer maturities has dropped off more than at the shorter end?
Absolutely. The longer end of the municipal curve typically behaves less mathematically true to its duration, if you will. As mentioned, there's a scarcity of product, and there's just a great deal of demand, as we know from the demographics. And so the longer end typically behaves better than interest rate duration might indicate. It also has very good capture in terms of the yield ratios. The short end of the curve has been bid up in municipals like everything else has, and so it's less compelling. So what investors typically do with us is they'll keep a pile of money in cash. Look, we're not gonna scoff at 5% yields for risk-free assets, but we're also going to note that as you move into this peak tightening cycle, which is where we are, we can argue 25 basis points from here, I think, but every subsequent period for fixed investment, 1, 3, and 5, and the 5 tightening cycles I've been involved in, has been very generous for fixed income returns. So let's not think that 5% is going to be earned forever. It's going to be fleeting.
Well, there's still, though, a lot of competition, though, out there, Jim. And I am curious that when we talk about the auctions coming up for some of the debt coming out of some of the deposits and loans coming out of the regional banks here, when we talk about the interest rates that you can get on some of these safer investments here, where does munis fit into that, though? Is there enough money to go around, I guess is what I'm asking.
Yeah, well, I think there's going to be. And I think we're going to start to see as the Fed begins the peaking process, and I believe we are going to go into recession, an earnings recession, certainly, to be sure. You're going to begin to see people realizing that these yields, which are generationally high since 2007, are going to look very attractive. And I think we're going to see a reversal in relatively short order, probably to start the summer.